Okay, so what we want to talk about here is bank reconciliations. Why do we do a bank reconciliation? Okay, the big question is why don't we do a bank reconciliation for many of you that don't do bank reconciliations? I do bank reconciliations as a part of my profession. And in the case of accounting, your work's not done until you've actually completed all the reconciliations of your cash accounts, at least. There is such thing as reconciling accounts, like accounts receivable or accounts payable. And all you're doing is reconciling that number on the financial statement to the individual invoices to your customers or to your vendors. So how does a bank reconciliation work? Well, you have a bank side of your accounting records and you have a book side. So the book side are your actual books that you have for your business. And that has a running balance. Okay, you have a current balance, you add to it and you subtract from it, and then you eventually end up with an ending balance. Now your bank is actually the one that keeps track of all your money. So the bank has an account called a DDA or demand deposit account. It is a liability to the bank. So it's down there in the liability section because they owe you every penny that's in there plus interest. But at some point at the beginning of the month, you want to reconcile the books that you have to the books that the bank has for you. And they seldom ever equal unless we do this reconciliation. So the first thing you'll notice when we do a reconciliation is that the bank's balance is not the same as the book balance. Of course not. Things are happening out there instantaneously, but for a moment in time, we have to stop and do this in order to prove that our records are accurate, our books are accurate. This is a part of the monthly closing, the monthly adjusting entries that you do. It's the most probably important thing that you do. I reconcile upwards 3, 5, 10, 15 bank accounts every month. Some are mine, some are my clients. All right, so now in your book, it's always a little surprising to me. I'll put books here and bank over here, or sometimes I'll put bank over here and books over here. It really doesn't matter. What we ultimately want to do is we want this number here, the adjusted bank balance, to be exactly the same as our adjusted book balance. If it does not, then we have to research and find out where we have gone wrong. There's possibilities of errors in our books or even errors that the bank makes. Now, just know I've worked in a bank and I've been part of the internal operation of a bank, and the odds of a bank making a mistake are very, very low, but they do happen. And the only thing you can do about an error that you find on your bank reconciliation, in other words, a check that comes through that's not yours, or a deposit that's made that's not yours, and I could tell you stories about that, is to call them and have them fix it, and they will. Okay, so first, before we do any kind of bank reconciliation, which will be in the next video, is we're just going to talk about what goes where in a bank reconciliation. So if you can screenshot, snap this, fine, do it. I think it's a really good and a pretty comprehensive picture as to what goes into a bank reconciliation, where individual things go. So let's talk about the bank side. Now the bank, we deposit money into the bank from our customers, sales, cash sales, any number of things. We deposit it in the bank. So the bank gets deposits and it causes our bank account to go up. And then we write checks or we use our debit card or whatever it is we're doing, or however how we do it. And of course, that's coming out of the bank, isn't it? So your bank will actually receive that check. Let's just do a check because it's easier to see. I write a check today, give it to somebody, they take it to their bank, they put it in their bank clears it, it's called clearing, clears it through your bank, and your balance goes down. And that takes upwards of a day to 3 days for that to actually happen. So that is why the bank balance and the book balance seldom ever matches. It's about timing. Because if we just held our bank account still for about 4 or 5 days, in theory, your balances would be equal. And if they're not, then there's obviously mistakes. So let's talk about the bank. Now, on the add side of a bank reconciliation, on the bank side, is deposits in transit. A deposit in transit is nothing more than a deposit that you made to your bank that hasn't yet been added to your account. Now that timing is very narrow, but on any in the month, if you go in there the last day, and let's say the last day is on a Saturday, and you drop it through the night drop, yes, you can still drop money through a night drop. That goes in there. They're not going to count it until Monday, but the bank statement is going to be as of that day. So that bank deposit isn't going to be recorded on that statement for that month. So this is called a deposit in transit. It's a deposit that's on its way to arriving at your balance. Now that deposit is in this book's balance. So we have to add it to the bank's balance to bring them closer together. So just know this for now. If nothing else, you'll just memorize, right? Deposits in transit are an add to the bank's balance. And sometimes there's bank errors that we may have to add in as well. You can go ahead and just kind of ignore these. I don't believe this chapter really gets into bank errors and or book errors that much. We want to focus on the real building blocks of a reconciliation. The next one is called outstanding checks. Now, you don't see deposits in transits or outstanding checks over here because this is only going to be on the bank side. Now, an outstanding check is you writing a check, giving it to your customer. It's the end of the month. The bank statement comes out. That check hasn't hit the bank yet. It is in your books here. It has already lowered your balance in your books, but it hasn't made it to the bank to lower that balance yet. So we'll just wait on that and it'll eventually come. Now, so you're going to take this number, add any deposits in transit, and subtract out any outstanding checks. And that gives you what's called the adjusted bank balance. Now, it doesn't matter if it's over on this side or that side. Now, let's take a look at the books. The books are much more interesting and much busier because those are the books that we keep and action is happening all the time. So we start off by looking in our bank, our cash ledger, and we see that we have a certain ending balance on our books. We enter it right there. Now, that balance is not going to equal this balance. By the time we get down here, this balance has to equal this balance. So what are some of the things we might add to our books? Now, if we add something to our books, it's because the bank did something to our books that we hadn't yet entered into our books or forgot to. Okay, so first thing, additions to a bank account not recorded on the books and book errors. Now, some of the things that can go here. Interest. Every month you get interest on your checking account. It's very minimal, but we nonetheless have to add it to our, we don't even know what the interest is going to be until we get our bank statement. So we add it to that. Now there's other things we can add to our books as well. We could ask, if we had rental properties, we could ask our tenants to make the payment to the bank. The bank makes the payment, records it, and then sends us information about the deposit, and we'd add it to our books. And if we're doing a reconciliation and we hadn't done it already, well, then we'd want to make sure we added any kind of rents or anything else here. So this is just things that the bank did to our account that we have to add to our books that causes our book balance to go up. So they've collected some money for us. We've earned some interest. They've collected a note for us, a number of things they could do for us that makes our balance actually go up. Now, the real busy part of a bank reconciliation on the book side is the deductions. Now, you could have deductions. It says here, deductions to the bank account not recorded in the books. Well, then that means what are some of the things that happens on the bank side or at a bank that we wouldn't enter until we got a bank statement? Well, service charges. So we would put service charges in. If we purchase checks, the bank will send you new checks, but then they'll give you a charge, and that'll be on your statement, and then you'll add it to your books. But that's going to take the balance down, right? Because they're charging you. One of the biggest charges on your books is called non-sufficient funds check, or non-sufficient funds customer. Customer, in the process of a sale, writes you a check, and you put it into your books, and it's part of this balance right here. But the bank statement comes and says that check was no good and it bounced. And so we have to put it here because now we have to take it out of that balance. Okay, so those are some of the things that we will deal with. So in the next video, again, we will look at a couple of bank reconciliations. You'll do even a couple more in your homework, and you'll get much more attuned to what goes where. But one thing I want you to make sure you understand is on the bank side, we add deposits in transit and we subtract out the outstanding checks and know what they are. Now, learning objective 1, which I'm not covering a lot, it's in a PowerPoint presentation done by one of our Smart Start instructors, did a pretty good job, is to know all this terminology about drawers and payees and things like that. And then here's some definitional stuff here as well. So, and here's some things that we add. Interest revenue, that's another one I didn't add. Electronic fund transfers is the customers transferring money in that we hadn't yet recorded in our books. So those kind of things. All right, so let's just proceed on to the next video and let's do a bank reconciliation.